Good morning, everybody. It's Thursday, June 13th, 5:26 a.m. Central Time. Grain markets are mixed this morning. July corn futures up 2 3/4 at 457. July soybeans down 2 1/4 at 1175. July Chicago wheat up 3 3/4 at 620 3/4. July Kansas City wheat down 1 at 636 1/4. July spring wheat up 4 1/4 at 672 1/2. Mackenzie, before we start today, we're going to ask the people to subscribe on YouTube. Guess what percentage of people that watch are actually subscribed to the YouTube channel?
Maybe like 15.
It's like I think 40% of the people that watch are actually subscribed. So that's the number. And you guys should hit the subscribe button and also turn on the notifications so that as soon as our videos are posted, you'll get a notification on your phone. I never ask you guys to do this anymore, but go ahead and do it and help us out. Okay, let's start off with this China corn story.
Alrighty, so dry weather in China may hinder the development of the country's corn crop. Large areas of Chinese corn country have seen less than half of their normal rainfall since May 1st. The forecast offers spotty rains, but no significant relief. China's ag ministry said early this morning that recent high temperatures have had an adverse impact on summer planting. USDA projects that China will be the world's second largest corn producer this year, behind only the United States.
Let's look at China in context as a corn producer and user. So China is projected to be the world's second largest corn producer behind only the United States. They're much larger than Brazil. When it comes to importers, China is projected to be number one, pretty close to Mexico. Those two should be neck and neck. And these are new crop projections, so that may not be entirely accurate. When it comes to domestic consumption, China is number two, behind only the United States. Domestic corn consumers there's two big ones. There's the U.S. and China, and then Brazil, the EU they're way behind where China and the U.S. are. So look at some maps here. So this is that's like maybe, I don't know, 40% of Chinese corn country that's been very dry. This is percent of normal precipitation since May 1st. This is a map from Marcus Weather. This is great stuff. And you've got areas that have seen 20 or 30% of their normal precip since May 1st. And here's kind of the production density map. So you've got, I don't know, call it 30 or 40% of the Chinese corn crop that's been very dry. They're on a similar crop cycle to what we're on. They plant in like what would be May or June. And then, we're kind of early season right now. If this continues here for another few weeks, I think this is something that could influence the marketplace. Absolutely. I mean, 23 million metric tons of imports is, the biggest in the world, but it could get a lot bigger if they had crop problems. I know China's talked about being self-sustained and they don't really want to import much and they're trying to increase domestic production, but that stuff ain't happening this year. This year they need a crop. And if they don't, maybe that will be a positive for the markets. It's absolutely something to pay attention to moving forward.
Wednesday's USDA report featured no major surprises. USDA left its U.S. corn and soybean production estimates unchanged compared to last month. Only minor changes were made to the old crop U.S. balance sheets. USDA cut its estimate of Brazil's soybean crop to 153 million metric tons from 154 million metric tons last month, but left the remaining Brazil and Argentina estimates unchanged. The Russian wheat production estimate was cut to 83 million metric tons from 88 million metric tons previously.
Heard a lot of complaining about the U.S. yield numbers. Oh, they left the corn yield number unchanged at 181. They left the soybean yield number unchanged. That's just the way that USDA works, guys. They start with the trend yield, and then they'll adjust it beginning in July or August. They typically don't make a June adjustment unless they've got a big reason to do so, like really late planting or really bad crop ratings. And we just don't have those things right now. So they're going to kick the can down the road and wait until they know a little bit more to adjust things. We saw some minor changes on the demand side of the U.S. balance sheets. These global numbers, I think the trade was looking for something more. I think the trade, or the bulls rather, wanted to see a Brazilian production cut. They didn't get it. They wanted to see a bigger Brazilian soybean production cut. They didn't get it. We did get the cut to the Russian wheat crop, larger than I thought. They went from 88 down to 83. I thought they'd go down to 85 or 86. They were a little bit more aggressive, but that was not enough to bail the wheat market out. Wheat futures fell yesterday and remain under pressure. So the report, big picture, non-event. It's a placeholder until we get to June 28th. That's the planted acreage report, and that's one of the biggest reports of the year.
So if you guys are not subscribed to our premium content, you need to do so. Joe, can you tell me about yesterday's video?
USDA report day is a good day to be a subscriber. I start taping our USDA snapshot right at 11 a.m. Central when the report's released. I think I had it blasted out by 11:08. So you get a real quick, like 3 or 4 minute snapshot of the report. what are the high level items, what are the highlights, what are the things that you need to know. On Sunday night, Pete will be doing our pre-open weather update. These are videos that go out on Sundays at 6 p.m. Central Time during the summer, and these are going to become increasingly more important as the weeks go on here. The market's going to be trading U.S. weather almost exclusively for the next, call it 6 to 8 weeks, maybe beyond that, depending. And Pete on Sunday night is going to run through the forecast, what's changed, what hasn't changed, and what does it mean for the market. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. It's a $50 per month subscription. You can cancel at any time. There's no other fee. There's no other obligation. Nobody's tried to sell you anything else. Our morning email goes out every single business day at 5 a.m. Central Time. It includes all of my cash grain marketing recommendations, which are super transparent and easy to follow. All of our premium videos, a whole bunch of charts and graphics that we don't show you here on YouTube. You know, on YouTube and on the podcast, we do news. In the premium stuff, we do analysis, we do grain marketing, we do policy, we do crop insurance, all of that stuff that can actually help you to make decisions. I don't know that you can make a whole lot of decisions based on what we do here with the public stuff. So check that deal out this morning, guys. I will forward you a copy of this morning's email if you sign up.
Rain will return to the U.S. Corn Belt during the next couple of days. Parts of Illinois may see up to 1 inch over the next 36 hours, while a larger system is slated for parts of Nebraska, northern Iowa, and southern Minnesota this weekend. The 5 to 10 day period introduces additional rain for western and northwestern areas of the Corn Belt. States that are likely to remain drier over the next 10 days include Missouri, Illinois, Indiana, Ohio, Kentucky, and Tennessee. Temperatures are likely to run slightly above normal during the next 10 days. The 6 to 10 and 8 to 14 day government forecast continues to favor odds of above normal temperatures.
Big divide here again. The forecast is not very different than it was yesterday. You've got a split. I mean, you've got half the Corn Belt's going to be wet and half the Corn Belt's going to be dry. I don't exactly know what that means in terms of production prospects. I think some of these areas in Minnesota, northern Iowa could be too wet. Absolutely. And they're going to dry out in the central and eastern Corn Belt. And what does that mean with this heat coming in a normal year where we weren't so excessively wet during the spring? This would probably be a friendly forecast. I just don't know if it is right now. The GFS is back and forth with the heat, but the government pushing this heat in the 6 to 10 and also 8 to 14 day periods.
U.S. ethanol production declined last week. Weekly output of 1.02 million barrels was down 4.6% on the week and down 1.3% versus the same week last year. Ethanol stocks were pegged at 23.2 million barrels. The print was up marginally compared to the previous week and up 1.2% compared to the same week last year. Implied gasoline demand was up 1.1% compared to the previous week, but down 1.9% versus the same week last year. On average, over the last 4 weeks, implied U.S. gasoline demand is down slightly versus the same period last year.
Ethanol production is strong. I know some of these ethanol plants have had to bid up for cash corn. There's some really good cash corn bids out there right now. And if you guys are sitting on some old crop bushels, you may want to make a phone call and see what your basis is doing this week.
USDA reported another flash sale of soybeans on Wednesday. U.S. exporters sold 4 million bushels of soybeans to China for delivery during the current marketing year. This is the third flash sale of soybeans purchased by China in the last 4 trading sessions, totaling 12 million bushels.
Okay, so they're back, but they're back for small amounts, and the market doesn't seem to be buying the idea that this is going to continue because the soybean market has acted very poorly. We hope this is a sign of things to come. These are all old crop purchases, I believe. We still haven't seen China buy a single cargo of new crop U.S. soybeans. I think that's on the way. Maybe they're going to be smaller numbers. Maybe USDA is too high with that big new crop export projection for the U.S. We'll wait and see. I mean, this is good to see. It hasn't been a needle mover yet.
High-tech agricultural startups are faltering. The companies entered the market expecting to take on competitors such as Cargill and ADM. They plan to move conventional agricultural management and trading into digital platforms, providing information and tools to alter ag practices. Instead, the companies have struggled due to their inability to connect with farmers. They are also contending with a tough financial environment. The startups entered the industry at a time when interest rates were low and investment funding was high. Last year, investment in farm and food technology dropped nearly 50% from the previous year to its lowest level since 2017.
So, Mackenzie, these city boys with no ag background think they can just jump into the farm space and be successful right off the bat, right?
Yeah, good luck with that.
Well, if you guys want the playbook, if you work for Indigo or FBN or one one of these other ones, Grow Intelligence, give me a call and we'll sit down. We'll do a consulting session. It's going to cost you though. It's going to cost you. Get your checkbook out. Lots of zeros involved. I'm just kidding. Here's a couple things from the article. Indigo Ag, once a marketplace for trading and shipping grain, has cut jobs and shrunk its business. Farmers Edge was taken private at a tiny fraction of its initial public offering. Grow Intelligence, named by Time Magazine as one of the 100 most influential companies, is shutting down, according to a person familiar with the matter. Matt Karstens is CEO of Landis. He said this at something called the Agritech Innovation Summit in San Francisco. He said, "How many farmers do you see here? We're all talking to ourselves. That's cool, but somebody's got to execute it on a farm." What else was in the article? I highlighted a few things here. The CEO of Indigo, Dean Banks, said this: "It's a lot easier to talk about disrupting than it is to actually disrupt." So I guess it's good that they're becoming self-aware. Farmers Business Network is probably the one that has the biggest foothold here and has done the best. I know we have a ton of subscribers that are members of FBN, and they've got a pretty wide reach. But they said, even their CEO, the down cycle in the ag industry over the past 2 years has affected many companies, and FBN has not been immune. So I think that they have some issues of their own. But we've been talking about this. I mean, there have been articles about these ag disruptors for years, how they were going to disrupt everything from, fertilizer sales to seed sales to grain buying to marketing to all sorts of different stuff. And a little bit of it has happened, but not to the extent that that the news articles and people were talking about a few years ago. A lot of this stuff just really hasn't gone very well. So a lot of big venture capital, Silicon Valley money has just kind of vanished in all this.
The growth of U.S. renewable diesel is causing a shift in global feedstock supplies. According to the USDA, starting in January of next year, the blender's credit will change to a producer credit. This switch will cause a reduction in vegetable oil imports into the U.S. It's projected that the soy market won't be able to meet the need for biofuel in the near term because of the high demand for vegetable oil. As a result, U.S. soybean meal supplies may become excessive, while soybean oil supplies may be limited.
Admittedly, this was like a 15-page report. I kind of skimmed through it. I didn't read the whole thing, but they're kind of going back here with this piece, and this is direct from USDA. They're going back to stuff that we were told 2 years ago, that soybean oil supplies are ultimately going to be really tight, and that we're going to have this excess of meal ultimately. We're going to have to export a ton of it. There's going to be a glut, and none of that has happened yet, but it may be on the way. The projections are still out there. It looks like this is still go. Is it happening as fast as we'd like? No. These rule changes that are going to happen on January 1st might be the catalyst for this. California is still the one that's using all the renewable diesel, vast majority of it, more than half. So say what you want about California and people from California, but they are helping us out in a drastic manner with renewable diesel. And this is a very good thing for the soybean market, especially given that our biggest buyer, China, has been very much absent when it comes to new crop purchases in particular.
Inflation eased last month and fell below economists' expectations. The CPI remained steady in May compared to the previous month, falling short of the expected 0.1% gain. On an annual basis, consumer prices rose 3.3%, slightly lower than the projected 3.4% increase. The markets are pricing in a 69% chance that the Federal Reserve will begin cutting rates in September. Yesterday, the Fed announced it expects to cut rates only once this year. Policymakers reiterated the need to see additional data showing that inflation is moving steadily toward 2% before they begin to cut rates.
The stock market made new all-time highs yesterday. At least the S&P did. The U.S. dollar fell, which is roundabout supportive for commodities. I don't know that it had any impact yesterday. Here's the new dot plot. So basically by the end of 2025, I think the way that this works is that they think that the Fed fund rate's going to be down to like 4.25%, 4.125%. Longer term, they'd like to see it back at 2.5%. You're going to have to see some more progress on inflation to get there. The idea is out there that their new inflation target may not be 2%, and it may be something higher than that. And that, if we're 2.5% or somewhere in that neighborhood, maybe that's when they cut. But only one rate cut now being projected for this calendar year. What did cattle do yesterday?
They were lower. Feeders were an average of 42 cents lower. Live cattle closed an average of 52 cents lower. Box beef prices softened yesterday. Choice ended the day at $317.60. That was down 61 cents. And select ended the day at $298.93. That was down $1.69.
Outside markets, pretty quiet. U.S. dollar's up a little bit. Stocks are mixed. Bonds are off just a little bit. Crude oil is down 62 cents. In the July WTI, it's 77.87. Have a great day, guys. We'll talk to you on Friday.